Hi guys, how you doing? Thanks for tuning my YouTube channel. I'm here to analyze Alibaba and tell you in the process why I think it's a good investment. It's been a while since my last video of Firecap, and there is two reasons. First, my first kid born, and I'm a little exhausted. And second, today market valuation, in my view, does not leave you with a huge margin of safety. I mean, a lot of companies are currently expensive relative to their historical average. It doesn't mean we are in a bubble. It's just about the indirect relationship between stock prices and interest rate. The issue here, in my view, is that in the medium term, economic growth will be will probably decline, and the Fed must increase interest rate. So we will see a drop mostly in the Nasdaq index. So why the Nasdaq? Basically because the margin. Anyways, guys, I'm going off a tangent here. Let's go back to the track and talk you about this amazing business. Well, guys, you know the drill. Please read the disclaimer. This video and its content is only for educational purpose. So if you want to invest in any security, please do your own research. Thank you. First of all, I want to talk why I think China is special and why we should be aware of the spectacular accomplishment that Chinese society made in the last 30 years. It really amazed everyone who knows something about economics, right? Despite China communism as a core of their society, the economics is running totally capitalistic. Perhaps it's not exactly as the book definition, but the system is working for them. I mean, it's working pretty well, right? So let's start to keep any judgment outside the analysis so we can see in the chart something undeniable, clean, reliable, which is numbers. China poverty in 1990 was around 60% of the total population, and now it's less than 1% for an upper middle income country. There is no country in the history of humankind who accomplished this goal in such short period of time. Now, today China GDP is around 19% of global GDP, so it's estimated that in 2030 or so will pass the US as the world leader economy. And if you make a simple calculation, let's say now the US has a $64,000 GDP, right? So, and China is around 11,000. So we could say in theory in 2030, China could have a GDP per capita of 17,000. That's 55% more, and just multiply this number to the population, could be equal or tiny more than US GDP. I think it's not difficult to accomplish. So this chart tells you what percentage of the retail sales is related with e-commerce. The trend was growing very fast previous the crisis, and now this awful event quickly bust the transition all around the globe, and much more in China. Please keep in mind this information for the incoming slides because it is key to understand the strong future of Alibaba. Before talk about the company, let's see this chart, shall we? It's fascinating, right? So China currently is the second economy of the world and only has 6% of world equity market value. This really doesn't make sense, right? So my thesis is that in the long run, the distribution will be more balanced. I really think the China-US issue is unfounded because it's really in the best intention of both countries to get along. So basically, in the long run, common sense will prevail. So there are several reasons why I think Alibaba is undervalued, but in my view, these are the main reasons, and really it doesn't make sense at all. For example, Facebook in 2018 lost almost 50% of the market value due several reasons, but mainly because earning expectation, some Senate hearing, security breach scandals, and some weird relation with Russia. Well, you can name the reasons, but the underlying company was growing each year like a rocket, so the business was all right and functioning perfectly. Now, in China, Communist Party has the control over the country and businesses, but in my view, I think they understand what is better for the people and communities, so they impose rules and restrictions, and you know what? That's worth for them to follow the common prosperity. Look, guys, I understand investors' fear about Chinese stocks. And look, I live in the US, and in this country, we make the things different. And I love that. But that's it's American reality, and it's very different from other countries. I will say that in the next 5 or 10 years, the company will be all right, making more and better products and services for their customers. Um, well, let's continue with the presentation and show you why I think it's going to play that way. Now, Alibaba is mainly an e-commerce business, and it's one of the biggest company in China that provides client to client, business to client, and business to business, using different subsidiaries and websites to make money. People commonly think that Alibaba.com is only one business, but in reality it's not, and in fact, it's not that important in terms of revenue. The core of the business is China retail with Taobao and Tmall, which are the largest retail commerce business in terms of gross merchandise value in the world. Basically, Taobao is a platform where small business and individuals sells products to consumers, and Tmall it's a platform where higher-end brands interact with consumers. Not only that, the incredible things for me is through Taobao Marketplace, consumers can also access to Idlefish, a consumer-to-consumer community for long-tail products, and also can access to Tmall products. So long story short, they incorporate all the channels through Taobao Marketplace to interact across all China retail ecosystem. Now, the other relevant in terms of revenue contribution is Sound Art, which is one of the largest supermarket chain in China. And of course, there is a lot of more businesses that we will talk in the following slide. So Alibaba have a business model different from his main competitors, like JD, Pinduoduo, and of course Amazon. They make money from different fees, marketing services, and cloud services. But they mostly are the intermediaries between the business and the client. So basically they provide the website and services to make sure that the trade goes on. You can pause the video here if you want to know about the fees in the different segments. Alibaba and their subsidiaries are just a marketplace. They do not own inventory. On the other hand, Amazon, it's a reseller who own inventory and sell directly to their customers. And also, of course, is an intermediary but taking a cut of the sale. Finally, both have the cloud business that is more mature, of course, in Amazon, and not even close in market share. So now that you know how Alibaba makes money, let's continue. Now, let's start to dissect the business. What I'm start to do is talk briefly about every sector in Alibaba business. First, we got Taobao and Tmall, China's biggest online shopping destination with 450 million monthly active users. You can find branded products, original designs, and fresh products. The thing here is not only an e-commerce, you can also watch store live streams, which obviously generate community, and of course it's very avant-garde in the e-commerce business. Plus, you can try your products virtually. Basically, it's like a social media e-commerce. Taobao and Tmall are huge and make almost 50% of total revenue of the company. And companies like JD or Pinduoduo are a real threat, but still relatively small in terms of GMV, as you can see in the left picture. Now, here the chart look tricky, but in reality it's not. Alibaba has almost 1 billion in active consumers in China, which make them the leader in this measure. And now you should ask, but Francisco, JD is growing faster. I think that's normal due to the relative size between both. And just put this in perspective, Alibaba is older than the competitors, and of course, when you reach almost 1 billion in clients, it's more difficult to capture new members because obviously there is not so much left. Anyway, let's continue. Now, this is one of the most interesting charts regarding operating income. As you can see, the main competitors are still in a developing stage, so they are still making huge expenditures to take market share. For example, JD with JD Logistics expenditures, it's a heavy cost from them. Alibaba big expenditures are in the cloud business, logistics, and international e-commerce. In China retail market, they have a solid position in terms of market share and profitability. Having said that, I do think margins are going to contract more to the recent anti-monopoly measures. Now, let's shift to other segment. Alibaba owns 72% of Sun Art Retail after the last purchase in 2020. The company operates RT Mart, the biggest grocery chain in China in terms of revenue. First, let me say this. Sun Art Retail Group has been growing like every huge grocery store in the planet, not so much. We all know that consolidated grocery stores, for example like Walmart, grow 3% on average every year. This case is basically the same in terms of revenue growth, so why the heck you buy a company that is practically not growing? In my view, there's two reasons I come up with. First, you need to be available to much people you could, and brick and mortar help you with that. And second reason is Freshipo. Freshipo, in my view, is a fantastic relative new business invented to change the experience of retail. The business operates in different shopping scenarios. Pick and go. For example, you can order with your app, pick up with your QR code, Freshipo restaurant, Freshipo farmer market, Freshipo mini, and more. The powerful innovate infrastructure and the use of data allows them to increase merchandise margin, enhance consumer loyalty with the app, and real-time visualization of labor efficiency. In my view, the pandemic changed how people buy things, so I think what Freshipo is offering is going to play out well. A true high-tech experience. Now, international commerce retail, it's only 5% of the revenue contribution, but I can see here a huge potential to the quantity of people in Europe, Middle East, Africa, Central Asia, and Southeast Asia. They think the number of potential internet consumers could be around 1.2 billion, and taking that they have only 12% in both markets, they frankly have a big opportunity to acquire market share. In this case, they are still in the fine-tuning revenue model, focusing on gaining market share. If they achieve this task, it's very likely they continue to the other step, which is monetization, value addition, and efficiency. Now, let's talk about Lazada, which is the number 2 in Southeast Asia. Lazada it's an e-commerce that serves for customers in Indonesia, Malaysia, Philippines, Singapore, Thailand, and Vietnam. Now, Lazada is still in the market share stage. However, last quarter the growth was very impressive. As you can see in the chart, they double in almost all measures. Having said that, it's important to talk about his main competitor, which is Shopee by C-Limit, which is expanding into multiple markets, not only Asia, also France, Poland, Spain, India, Argentina, Brazil. Shopee Playbook is basically give free shipping, free commission to sellers, and cashback. This approach, which is very bold, has proven to work very good in countries like Brazil, for example. allows them to control market share in just 2 years versus Mercado Libre. You can see the strategy gave them a growth of almost 80% revenue, which is stunning. Nowadays, Shopee controls 32% of Southeast Asia market. But like I said, only Southeast Asia is a huge market. It estimated that GMV is set to reach 360 billion in 2025. If we think for a minute, we could say if Lazada maintained market share, they could double revenue in just 3 years. I don't see a reason not to compete in this market. Now, logistics service. Alibaba has 63% of Cainiao Logistics, which operate in a global scale. Alibaba Go is becoming to the equivalent of Amazon logistic operation and fulfill orders within 24 hours in China and 72 hours internationally. Cainiao Port, which is the community service center, has become China's leading last mile network with 2/3 of the cities covered and 30,000 digitalized rural posts. Cainiao Guogu is China's leading crowdsourced parcel delivery platform, offering 30 minutes pickup at your doorstep. Between Cainiao Post and Guogu, the daily package volume has increased 88% to 64 million packages per day year to year. Over 300 unmanned on-demand vehicles have been deployed to deliver packages to the consumers, and more than 100 unmanned digitalized locations created, operating 24/7 for consumer convenience. Cainiao has over 10 million square feet meters of logistics parks within their operation and now has global delivery option for as low as $5 for 10 days delivery to 20 countries and $2 for 20 days delivery to 50 countries. Most of the Chinese people live in lower tier cities and less than 10% of China, 1.3 billion people live in major cities like Shanghai or Beijing. Today, Alibaba has us covered, and now they are focused on reach the lower tier cities, which it constitutes almost 70% of total population, or 3 times US population. As you can see in the picture of the left, their strategy is working very well, which is in direct relationship with the future of retail sales. They understood JD tailwind and they act. We will see the result in coming years. Unlike many other express delivery firms in China, JD Logistics owns a warehouse system, along with a variety of transportation tools. In other words, JD Logistics has itself supporting storage, which helps them to connect clients almost directly with the upstream merchants, forming solid relationships. So JD great success in the last years was due to the proprietary logistics services, which allows them grow in a very rapid pace in the retail ecosystem. Like I said in the last slide, I think Alibaba understood that e-commerce sales is in direct relationship with fast delivery. I think they are making the expenditures to give a better client service. Now we can see local consumer service contribution, which is in the case of LM, Alibaba Food Delivery Services. In my view, has a difficult future. I will say that the year-to-year growth is relatively good with a sizable market, but in the case of, for example, Fliggy, which is Alibaba online travel platform, and the former is not looking quite good. I should say that Ctrip, or nowadays known as Trip.com, is a very interesting company with a dominant position in China. Probably could take a lot of market share of Booking.com or others soon. Chinese tourist pre-COVID expenditures was around $280 billion, around 20% of tourist global expenditures. So we know the borders are closed, so my guess is the rebound will be huge. And of course, Fliggy will benefit from that, but Trip.com is going to be the alpha. We know that Fleek is more focused in millennial premium trips, but anyways, I do encourage you guys make your analysis about Trip.com. I think could be a multi-bagger, just like Booking.com in the old days. Now, let's talk about the huge market food delivery in China. It really amazed me, don't you? It's almost 5 times the US market size and is expected to grow 12% compound annual growth rate. However, here things are not looking good for Alibaba. The success of Meituan is very clear, and the reason behind is Tencent. Tencent owns 19% of Meituan, and due to the integration with WeChat, they are delivering tremendous success by integrating their apps. So people could just go to WeChat and buy food via Meituan and avoid download LAM app. Plus, with Meituan app, you can also look at restaurants rating just like Alibaba Kubei, but with more and more restaurants offered. So my guess is this fight is a difficult one, and market share eventually will go to Meituan, just like now. I don't see a good opportunity for Alibaba in this sector. My guess is they should focus in other part of the business. Here Alibaba doesn't have an edge. Well, AutoNavi, AMAP or Gaude, whatever you want to call it, is the leading navigation app in China, growing like a rocket every year. The daily active users is 200 million, and now they did some changes that allow them suggest the users of new locales to explore, for example, dining, nightlife, entertaining activities. So via the app, they can book hotel tickets or ticket events, traveling tickets, etc. The main thing here is they want to unify the AMAP, Fleagy, and LAM ecosystem in one and bring more possibilities to users. For example, if you want to go to a concert, you turn on your AMAP, choose the address, buy the ticket, and then take a taxi like Didi or Gaude taxi to your destination. I think it's pretty interesting, right? And bring possibility and choices to the users, and also an easier life. It's fair to say that nowadays Alibaba lose money with this app, but I'm pretty sure that eventually it can monetize correctly, just like Google Maps. Now, wholesale, as you can see, is growing in a decent pace. I don't want to comment so much because in my view there is more opportunities in other segments, so let's continue. When it comes to China internet healthcare industry, two names comes, JD Health and Alibaba Health. Both companies generate over 80% of revenue from pharmaceuticals and healthcare products. It's estimated that China healthcare market size will be around 13 trillion yuan in 2025. Alibaba is showing decelerating growth but has reached profitability. The margin is quite low, but they have around 280 million active users who made purchase as March 2021. And they have a new app called Dr. Deer with more than 180,000 consultations per day. JD has basically the same business, but it's growing faster. Plus, they made home doctor visit, which Alibaba doesn't offer. However, Alibaba Edge comes from the synergies with Alibaba ecosystems because it allows them to acquire new customers very easy at lower cost. Finally, I think this market has a huge potential in the area of telemedicine, more than selling online medicines. And if they do the right things, they will make more profit for sure. Now, I want to talk about Alibaba Cloud business, which is only 8% of total revenue. As you can see in the chart, Alibaba has 8% market share in a worldwide scale and 34 locally. Globally speaking, Alibaba has a lot of challenges and space to increase market share. And this is because China cloud computing is way behind to the US in terms of how much China public spend related with GDP. For example, the US public cloud spent 11.4% of total IT expenditures versus China 2.7%, and public cloud market is tiny compared with the US. We all know that public cloud in the US is mainstream, and in China the share between public and private is very similar. And it's important to say that China public market, according to IDC, is only 11% of US public market. So basically, in my view, there's a lot of growth to come. So we all know that Alibaba lost a big client last year, so the growth decreased in relation with the years before. But I will say that if you tell me that my business will grow 33% a year, for me it's a really amazing stat. Therefore, if we try to be meticulous, Amazon year-to-year growth was not always increasing, as you can see in the upper right chart. So the 28% compound annual growth rate of Amazon Web Service um, revenue is a very solid number. So what I'm trying to say here, just thinking that for a single year Alibaba growth declined in real terms, and therefore um, say with authority that Ali Cloud is just doomed, it was basically not having a clue how this business works. I certainly think that Alibaba has a big gap between Amazon and Azure, so the expansion in South Korea and Thailand in 2022 could result in reducing this gap. Now guys, in the right picture I put two tables, just to see how important is the cloud business for Amazon and Microsoft. Amazon nowadays makes a big chunk of the revenue with AWS, so we could argue that given Alibaba's stakes, it's very likely to generate a big upside in revenue. Now, we all know that the cloud left the company with incredible margin. Amazon operating margins over 30%. Alibaba is still a baby comparing with AWS, but last quarter was their second quarter with positive numbers. So let's say that the projection of the picture in the left is correct. We could say if Alibaba maintained the actual market share, which is 30% in China, the revenue could hit 46.2 billion US dollar. That almost is 14% of current market cap, just only one segment. Now, let's say that Alibaba growth will be less than the year 2021, and we should expect that. Let's say Alibaba can deliver year-to-year growth of 30%, just like the last quarter. This means if we take the 9 billion revenue from fiscal year 2021 as our present value, the segment should hit at 25 billion US dollar in annual revenue by 2025. So basically you can project in different ways and the upside is very impressive. I leave you with that. You should think about the potential. Now, in September quarter, Yahoo daily average subscriber base increased 14% year to year comparing with single digit with Ishiki and Tencent, driven primarily by quality content and continued contribution from the 88 BIP membership program. Yahoo is kind of similar to YouTube, and I should say that it's the third in market share in China, which is a difficult market. The streaming company in China are starting to invest more in content to acquire new subscribers, but nowadays there's not comparison with Netflix and Disney and so on and so forth. I could say Yahoo is relatively mature compared to Netflix and 80% cheaper than the latter. If we take the $34 billion as total market revenue in 2025, just maintaining the same market share, which is 20 for Yahoo, we could project a revenue of $6.8 billion, which is 7x the current revenue. If they continue to invest in content, I could say that this goal is achievable and will allow them to start to make green numbers. In the following slide, we start to go deep into the numbers. You can see the return in net tangible assets a ratio that I like to use. This ratio makes the comparison with other companies in different industry easy because does not include all intangible assets that a lot of time distort analysis. Now, as you can see, the company has better return than Pinduoduo and very similar to JD. So the final conclusion is that it's a well-managed business. It's an understandable industry with a bright future. Now, this slide represents the operating margin of the main competitors of Alibaba. It's not new that Tencent, which is in my view is one of the best businesses in the world, has an amazing margin, but recently started to reduce stakes in JD.com, the first retail competitor of Alibaba. In my view, this move probably will affect JD growth because Tencent was backing up the company the whole way. Now, Pinduoduo is growing very strong, but their operating margin is still slightly negative, which in inflation regime could affect the growth of the company. Finally, it's fair to say that Alibaba margin has been decreasing over time due to competition and China anti-monopolistic measures. So it's reasonable to say that the margin in the retail ecosystem will decrease. But at the same time, I could argue in the long run, AliCloud will help them to maintain their profitability. Now, this is one of the metrics that I really like from the company because it shows the durable competitive advantage of the company that allows them continuously making more cash for the shareholders. I did project the free cash flow per share to 2026, taking some measures, but could be 16.77 US dollar in 2026. So basically it's possible to make 3x your money in 4 years, which is a decent return. Well, this is another important slide. We can see the earnings per share are increasing with a compound annual growth rate of 29.9%, which is pretty amazing. This makes you think, this company has a moat or not? I leave you the answer for you guys. Alibaba is focused in using proprietary AI and data technologies to build consumer insight to provide better and accurate experience. Taobao Marketplace not only sells products, also provide innovator services to engage clients. For example, consumers could engage with merchants through live streams, short videos, interactive games, and microblogs. The live streaming platform grew 90% last year, and really it's an excellent new way to improve consumer experience. It's not only that, you can also use the 3D showroom when you buy furniture and the virtual product try-on that allow you to try virtually clothes. And finally, this robots delivering package, oh man, I think it's just spectacular technology. I do think eventually all the major retailers in the world will make this upgrade. Well, here you have it, bears. What you want. This is the only risk I see on this business. The concerning number in the last earning was 3% year-to-year growth. Customer management is the core in the retail sector and comes from advertising and commission from Taobao and Tmall. The big concern here is the customer management only grew 3%, with competitors growing faster than Alibaba and Alibaba having this merchant support program. So if revenue grew slower than GMV, it's because of the merchant support program, right? So if this merchant support program continue, this is a real indicative that Alibaba is paying the customers to stay with them. That eventually is a game changer, and you need to get out of your position. I do think it's only a one-time thing, just like Mr. Daniel Thang said, but we must be vigilant. So let's dive into the scenarios. Please remember, this is not a perfect science, so numbers could change if you do your own research. Well, this is a scenario that I think is very likely to happen. Why? Because I like to be conservative. I use an average of the last 7 years in P/E ratio, price free cash flow, and so on. You can see the multiples in the lower right of the picture. This means that I think I could sell my stock in these multiples. But again, I like to be conservative because you can put, I don't know, 35 or whatever. But for me, it's better this way. You can see my consideration below. So the rate of return could be 14 or 15 each year, which is not as spectacular, but it's pretty decent. Well, keep in mind, guys, that my average price is $168. This is another scenario. This is pretty optimistic. I consider that the debt will keep the same that the sample before. The growth will continue super strong, 25%, and the multiples will be higher than before. I will say that it's possible, but I put this here just for the optimistic people. So if you take today's price, which is $122 or so, obviously your return will be higher. Almost finishing this presentation. Here you can see a volume profile chart. It's a composite of the last 3 years in a weekly basis. And well, we can see that right now it's generating volume in the low part of the chart. This means in volume analysis that is a fair price and the participants want to exchange paper in this level. Now, like I said in my last video, my decision to buy a security is solely fundamental. But when I put a trade, one of the things that I like to see is what is doing volume over time. By the way, this chart tells you where is the volume in which prices. So more volume, more participation, less volume, less interest. Remember, the market goes from balance to imbalance. Finally, it's important to add that a company doesn't have to kill earnings to make you wealthy. I think there is probably more risk owning US tech stocks than Chinese equities at this point. Chinese Communist Party has shown long-term commitment to improving the life of their people, while the US cares more about holding into their wealth. I would argue that CCP measures limiting games for 18 years old, for example, well, it's an extreme measure, but in reality, it's a very good one. China is truly a powerhouse with very sustainable long-term growth. When I hear people say that there is risk in Chinese equities, I laugh to myself and just think of what the risk word means. Volatility is not a measure of risk, it's an opportunity. Risk comes of the nature of certain kind of business. It can be risky to be in some business just by the economics of the business. For example, if business is cyclical or non-cyclical and so on and so forth. What I'm trying to say here is risk comes from not knowing what you're doing. If you understand the economics of the business and the price you pay, the people working there, my humble opinion is that you are not running a real risk. Well, and that's all, guys. Thanks for listening. I hope you like it. Again, sorry for my rusty English. I leave you with this remarkable phrase and see you in the next video.